Okay, everybody, we're going to get started. Can I get everyone to make sure your doors are shut and your other devices are turned off? I'm going to cover quite a bit of information in a short period of time, so I need your full attention. Also, everyone on this call will receive a copy of this training and the material at the end of the broadcast. My name is Chris Duffield, and I'm an account executive for Newline Mortgage. And for about the next 30 minutes, we're going to talk about investment properties. We'll cover how to identify an investment property, program and underwriting guidelines, as well as income calculations and documentation requirements. Also, before we get started, I'd like to take a moment and ask for your business. As an AE, I'm paid commission, so the best compliment you can give me is to send me a loan. If you find this training useful and learn something new, please send me a loan on any product. Newline offers some great FHA, VA, conventional, and USDA pricing right now. And I also have a lot of other trainings available on these products. So please don't hesitate to contact me if you have questions or feel you need more training on any of the products that we offer. So let's go ahead and jump in here. An investment property is a 1 to 4 family property that the borrower does not intend to occupy. In other words, they already have a primary residence and do not intend to move into the new property permanently or even temporarily. There are many scenarios where borrowers may think they're not really purchasing an investment property. They could be trying to avoid the high costs associated with these loans, or they may think of the property as a second home or a home for a family member or a friend that maybe they're just trying to help out. So I've got some bullet points here of things that you should be looking for, and definitely things that an underwriter will look for when identifying a property that's been submitted to them not as an investment property. So, maybe the loan came in as owner-occupied or a second home, and they're seeing other things and reading email chains and whatnot in the file that are raising suspicion. So some of the things they look at, so if a borrower states they are going to occupy the property full or part-time, and it's also going to be occupied by maybe even another family or a friend or a relative, and this is not typical. This isn't what they've done in the past. It's a new situation. You may have an underwriter think that this is an investment property. It could raise some questions. You may have a borrower who wants to purchase a single-family home in close proximity to their current residence, and they state they're going to occupy this new property. An underwriter is probably going to, think that this new property is an investment property, and in order for it not, it'd have to, there would have to be something in that scenario that would, make sense. But most of the time, they're going to think that's an investment property. If the borrower is purchasing a multi-unit property and wants to occupy one of the units part-time, like they're calling it a second home, that's considered an investment property. In fact, second homes can be only originated on single family. You can't originate a second home on multi-units. The borrower is maybe purchasing a multi-unit property and wants to add a relative as a co-borrower who is going to occupy the property. That is considered an investment property. Other things in the file, besides the scenario itself, there could be other clues. Maybe a for rent sign in the appraisal photos. I've seen that in the past. I haven't seen it a lot recently, but I used to see it a lot in the past. If you get a RUPSI and it mentions assignments of current leases or deposits, etc., that's a clear sign there that we're probably working with an investment property. And this all sounds pretty basic and simple. You're like, well, duh, yeah, these are obvious questions, but we actually do get files in where, I don't know what the background story is, but they're not coming in as investment properties when they should be. We had a couple of loans submitted to underwriting, both second home refinances. One of them, the interior photos did not have any furniture in the home. So it's really not that typical, to own a second home, especially if it's a refinance. You don't have any furniture in the home. The other one, after reviewing the conditions, or maybe it's because we pulled the 4506T, we ended up asking for tax returns, and the tax returns did disclose Schedule E income. So, no longer can the borrower, hide the fact that they're earning Schedule E income because, we pull those tax transcripts. So it really does, happen. Loans do come in, and they probably should be investment properties, but they're submitted otherwise. There's some repercussions to that, huge repercussions. It's important to get it right and properly identify investment properties. It can be costly to you, your company, and your lenders if you don't. Investors will often inspect properties post-closing and or look for things in a file that indicate the property is actually not a second home or owner-occupied. If they suspect there has been an error or fraud, they can require the lender pay the points and fees associated with the investment property. They could choose not to buy the loan, or they may even call the loan due for fraud, which could lead to bigger issues. So there's just too many post-closing resources where a lender or investor can research occupancy. It's not worth it if they find out a property really was or really is an investment property when it was closed otherwise. It's just not worth the fines, the loss of licenses, relationships, or lawsuits if there's an error or fraud. This kind of stuff, if you end up going to court or being investigated by the state, this kind of stuff ends up on the NMLS, and you just don't want that. So that's it. Make sure you're identifying those properties. There's huge repercussions if you don't. If you're ever unclear or unsure, contact me, contact the underwriter. We'll work with you on your scenario. If you're super uncomfortable with the situation and a borrower is kind of pushing the fact that no, it really is investment, but you're thinking otherwise, maybe consider not doing the loan. It's, like I said, it's just not worth it. I've been working with a broker who's actually going through an issue right now where they're having to address the fact that a property really was an investment property and they closed it as owner-occupied. And they sure are going through a lot of issues right now. It's just not worth it. All right, enough said there. So a couple things I'd like to point out real quick so that we know we're not talking about this today. There's some rental income from a couple of different sources that we get asked about on a regular basis, like rental income from a mother-in-law apartment or rental income from boarders or roommates. Even if it's on their tax returns, you can't count it. We just can't count rental income from those two sources. You can only count rental income from investment properties. And then before we get into the underwriting guidelines, I also want to mention that Newline now has the ability to loan to a borrower who owns up to 10 financed properties. So that's new for us. Our cap was 4. Now we can go to 10. Just know, though, that Newline will only expose themselves for loans. So they will not do more than 4 loans with one borrower. All right, let's get into the underwriting guidelines. So investment properties need to be arm's length. They cannot purchase from a family member. They have to all be arm's length transactions. Your FICO requirement is determined by DU, but it can go no less than 620. So we don't have minimum FICO requirements for investment properties. Your LTV guidelines and CLTVs. Now, I cut and paste this from our conventional matrix. That's why it looks kind of choppy here. And when I send you this material, you're going to get the matrix that goes with that, and it'll be a little easier to read. But for this training purposes, I cut and paste. This will work fine. This top section up here is for purchase and rate and term refis, and this bottom section down here is for cash outs. And you'll notice you've got your LTV, you've got your single family, your 2 units, and your 3 to 4 units, and you've got your LTV requirements for them over here. So basically, for a purchase, we're looking at 75% LTV on your multi-units. On a single family, you can go up to 85. However, you won't get mortgage insurance on that. So most of the time they're capped at 80. Maybe you can find a 5% second out there for investment properties. I don't know of any, but I would maybe consider the max at 80%, and your borrowers are coming in with 20. Of course, on cash outs, on single family, you can do a 75% cash out. On multi-units, you can go 70% for cash out. So those are your LTV guidelines. On your ratios, your max DTI is 45%. Maybe we'll consider exceptions with the DU approval. That's a big maybe. You're going to have high FICOs, reserves over and above the minimum required, but you're going to have some substantial compensating factors. We're going to stick pretty closely to that DTI guideline. Okay, so that's our underwriting guidelines. Now, income calculation and documentation requirements. Rental income may be used in qualifying the borrower. The documentation that is used to support the borrower's continued receipt of rental income and the calculation of such income depends on whether the rental income is received in connection with the subject property for the mortgage being underwritten or in connection with other properties the borrower owns. That's a really long sentence. So what I've given you here, this is a great little chart. You're going to want to get this training and print it out and keep this chart handy. It breaks down for you how to calculate the rental income and what documentation is required. So you've got the 3 columns here. This is if they're purchasing a multi-unit property and they plan on occupying one of the units. This is if they're purchasing a true investment property. And then this is for their other investment property that they own. So if we're going to use rental income, and again, this is on owner-occupied multi-unit or an investment property. If they're going to use rental income, the borrower's prior year federal tax returns, if the property has been owned for at least 1 year, in the case of a refinance, is required. Okay, or you can use the income approach from an operating income statement. So either or in that situation. The operating income statement is also called a Form 998, and that can be ordered through our AMC, and I'll discuss that in just a second. And you'll also need copies of their present leases, if applicable, positive net rental income from Schedule E of the borrower's tax returns or positive net cash flow from the operating income statement may be considered stable monthly income. Negative rental income from Schedule E or negative cash flow from the operating income statement must be considered a liability for qualification purposes. And then the table goes on. Okay. If an operating income statement is not required, if the borrower has owned the subject property for at least 1 year and reports the income on Schedule E in the case of refinance, you're not going to need an operating income statement. If you consider rental income from the subject property in qualifying the borrower, and the borrower has owned, and I'm reading right here, people, we're talking about the, basically we're actually talking about both, pretty much, both, whether they're purchasing owner-occupied multi-units or an investment property. So back to the operating income statement, it's required if you consider rental income from the subject property in qualifying the borrower, and the borrower has owned the subject property less than 1 year, and if the borrower does not report rental income on Schedule E. So basically the requirements for that operating income statement are the same. Now operating income statements are basically your operating income statement is the same for your multi-unit, owner-occupied, and your investment property guidelines or purchases. They're about the same. But double check, read through here, make sure it's clear, keep this handy, and you can always come back and refer to it. So if for their other property, use the following to document income. So complete federal income tax returns with all schedules for the most recent year if the borrower has owned the property for at least a year, or verify net rental income from signed leases if the borrower has owned the property for less than a year and the income is not reported on the individual tax returns. Aggregate net rental income may be counted as stable monthly income provided the reliability of receipt is clearly supported by the documentation in the file. Aggregate negative rent, rental loss from investment properties and 2 to 4 unit primary residence must be considered a liability for qualifying purposes. And again, you know, we're not going to require operating income statements for their other rental properties. Okay, tax returns, we've talked about that. You always need to try and get the most recent year. The appraisal, you know, we do use the income approach on an appraisal. It has to substantiate the rental income used for qualifying, and that is done with a comparable rent analysis that's part of an appraisal, and that's ordered through our AMC as well. I'll go over the appraisal guidelines in just a minute. Obviously, on the other rental properties, we're not ordering an appraisal, so we're not worried about the income approach. Lease agreements. Lease agreements, when they're purchasing an owner-occupied multi-unit or an investment property, leases by themselves may not be used for documenting stable monthly income for qualifying purposes. However, they may be used as support for the rental income used to qualify. So lease agreements are used in conjunction with your other documentation. Lease agreements for their other property may be used to document stable monthly income if the borrower did not own the property in the previous tax year. So you can use the income. If leases are used, then 75% of the gross rental income shown on the lease may be used to offset the mortgage and other expenses for the property to determine net rental income. So if they've owned property less than a year, you can get away with the signed lease agreement and use 75% of that. Reserve requirements, you have to have 6 months PITI in reserves for your investment properties in your owner-occupied 2 to 4 units. For all their other properties, you need 2 months reserves. You do need rent loss insurance. Okay. Proof of rent loss insurance covering at least 6 months of gross monthly rent is required if using rental income to qualify the borrower. Now, if they're purchasing, you know, an owner-occupied 2 to 4 units, they don't have to have the rent loss insurance. The borrower must demonstrate at least a 2-year history of managing 1 to 4 unit investment properties if using rental income to qualify the borrower. If they have that, then and they have the, or excuse me, we're talking about experiencing managing rental. I'm sorry, you guys, I just got totally sidetracked. So experience managing investment properties is not required if they are purchasing an owner-occupied multi-unit. If they are purchasing an investment property, the borrower must demonstrate at least a 2-year history of managing 1 to 4 unit investment properties if using rental income to qualify the borrower. Sorry, didn't mean to get off track there. That's it for the income and documentation requirements. There's some notes down here that you'll want to read through. Positive net rental income may be entered in gross monthly income. Aggregate net rental loss must be included as a liability. That's one thing to note. If the tenant is a family member, a copy of the fully executed lease and evidence of receipt of the rental income for 12 months or period of the lease, or if the period of the lease is less than 12 months, is required. Let me read that again. If the tenant is a family member, a copy of the fully executed lease and evidence of receipt of the rental income for 12 months or a period of the lease of less than 12 months is required. On a brand new lease, the evidence of the receipt of the initial deposit is required. If documentation could not be provided, no rental income may be considered. If the borrower requires rental income from the present home to qualify, you need to see the exiting property guidelines that I've included below. So they're keeping their current residence and buying another property, and they need to use the rental income. I'm going to go over that in just a minute. When the rental income relates to the subject property and the borrower has no history of receiving rental income from the property, an appraiser's opinion of market rent and, if applicable, copies of current lease agreements are required. So we've kind of covered this. You know, that market opinion comes from the market analysis that's part of your appraisal. I think we've covered actually most of the rest of this. So just double check and read through here. Here's our exiting property guidelines. So if the current primary residence is converting to an investment property upon purchase of a new primary residence, use the following guidelines to qualify your borrower. So existing properties with 30% documented equity, you can use 75% of the gross rental income to offset the mortgage payment and follow standard reserve requirements. The 30% equity in that property, in the existing property, must be documented using a 2055 exterior appraisal or an AVM. We can't do an exterior appraisal or an AVM on a condo or a 2 to 4 unit or a manufactured home. In fact, we can't lend on manufactured homes at all. So you would need a full appraisal if the exiting property was a condo or a 2 to 4 unit. Existing properties without 30% documented equity, the rental income cannot be used to offset the mortgage payment, and both the current mortgage payment and the proposed mortgage payment must be used to qualify the borrower for the new transaction, and you need reserves of 6 months PITI for both properties. And we need copies of fully executed lease agreements and proof of the receipt of the security deposit from the tenants and the documentation of the deposit into the borrower's account. So those are our exiting property guidelines. Please know that on an investment property, your max seller contribution is 2%, and gifts are not allowed on investment properties. Investment properties, I think we've talked about this, can be single families, 1 to 4 units, can be condos. However, your projects must meet the owner occupancy guidelines and cannot allow for daily, weekly rentals. You have to be careful on those condos that are an investment property. Appraisal requirements. So you can order a conventional single-family investment appraisal. If you order it that way, you're going to get all 3 forms that we've talked about, the appraisal itself, the operating income statement, and the comparable rent schedule. But, you know, as we also discussed, you don't always need an operating income statement. So you may want to, you know, make sure that when you order the appraisal that they're not including an operating income statement, and that saves you $100. You can always, you know, you end up not ordering one and you need one later, you can go back and order it. That's not a problem. You're just going to have to pay the $100 at that point. If you're doing an appraisal for a multi-unit property, that cost is $650. And then investment properties are available on all of our fixed-term loans and on our hybrid ARMs. So this could be maybe a marketing niche, you know, if you're looking for ideas, topics of conversation to get out there and talk to your referral market and your realtors and you know, your customer base. You know, on a fixed term loan, if they do a lower term like a 10 or 15 year, then they can own that property, you know, pretty quick, free and clear. And obviously, you know, the payment's being made for them. So I think that's a great marketing tool, you know, to take out there and you know, talk to your borrowers about and find out if they're interested in investment property, or if they know somebody that is, that you have a great, you know, 10 or 15-year loan that you can put them into and get that loan paid off quickly using, using the rents collected on that property. Or if somebody, you know, actually needs and wants, you know, income from that property over and above, you know, just the investment portion, You can put them on a hybrid arm, and obviously for the first few years of the loan, they're going to, they're going to realize a little bit more income, because they're going to have a lesser payment. So a couple of good marketing niches in there, or reasons to get out there and talk to your people. Lastly, just a couple things to know. You can do these loans for permanent and non-permanent resident aliens. And then just a last little plug about, following the underwriting guidelines, and especially the credit and the DTI. We really don't, go outside the box on these deals. We really do stick to the underwriting guidelines pretty close. Just because of the nature of the loan itself, it's a high risk loan, being an investment property. So we're not going to be as lenient on credit. If they have unpaid collections or judgments, probably going to have to be paid. Can't have any lates at all on anything in the last 12 months. Those are some of the things that come to mind. But again, if you're ever in question, if your income or your credit or your assets, whatever you have a question on, make sure that you're sending, your question to me, and you can provide supporting documentation. And I can get documents in front of an underwriter, and we can take a look at your credit report. We can calculate income for you. We'll take a look at your scenario and help you figure it out before you spend a lot of time on it. So just know that we're available to help you with that. And that is it for the day. Please don't hesitate to contact me if you have any questions. My name is Chris Duffield, and I thank you for your time.